Auditors. This is part of BA4 and the crucial area. Sometimes the students get into problems here. So try to get this area cleared up. When it comes to controls, there are two things. Number one, the external audit and then the internal audit. Do the external auditors do? Checking the financial statements, and that only is their duty. What kind of a company must do an external audit? Yeah, you're looking at a public company. Only public companies have a duty of doing external audit. Internal audit is not a requirement legally. Remember that. Be it a private company or a public company, internal audit is not legally required, but external audit is required from public companies. 4 points is external auditors. Yes, definitely the members. Normally at the AGM of the company, the external auditors are either appointed or reappointed. Normally their contract period is 1 year from one AGM to the other. Yes, they are nominated by the audit committee, but yes, appointed by the members of the company. Duties, to make a report, generally an opinion on the financial statements prepared by the directors. No other duties, remember that. When it comes to external audit, there are this three-party relationship, as we call it. Practitioner, intended user, responsible party. Auditor's duty is to report to the members because they are appointed by the members. Duty is literally to check on the financial reports prepared by the board of directors. Word is opinion on the financial statement. They just say if things are all right, true and fair. See an annual report of a company, it's a must that it includes the auditor's report. Go through the financial reports of the company, normally at the end of the financial year. It may take about a month or perhaps two, but normally by March in Sri Lanka the work should be finished. And we see a dozen of auditors taking up a contract with the company as per the members go through the audit, maybe 10-15 hours of the day, even more, day by day. 1,000 hours of going through this financial statements and finally coming into an opinion. If things are all right, they would say true and fair. That means audit is good. So, that's the engagement of the external auditor. But to do that, they should have enough evidence given by the company. We call it sufficient and appropriate evidence. Right to ask from the company necessary documentation, data, the files, the hard disks, you name it. Whatever the auditors request for their audit engagement as external auditors, the directors have a duty to make it available. Pile of data should be sufficient as well as relevant. That's why we call it appropriate for their evaluation. Have the right to demand an assurance from the directors. Now, whatever the data that the auditors are given by the directors, auditors have the right to demand from the directors an assurance about the truthfulness and the quality of those reports. Auditors can't just pass the information and say, okay, we never had time to check it, you check it and tell us if there are some mistakes. No, that kind of things directors have no right to do. Whatever the document released by the directors to the auditors and whatever they are asked by the auditors, the directors must release, right? Every single one of those documents is a liability or a responsibility of the directors with regard to the quality of those reports. If those reports are incorrect or misleading or parts missing or insufficient, directors are held liable. Just auditors, right? And the other thing is this: in a question, if you hear the word auditor, that means external auditor. If you see the word company, that means a public company. If you see the word director, that means an executive director. So auditors means external auditors, unless clearly stated otherwise in a question. So yes, what are the benefits of the external audit? Definitely credibility, the most important things. A company that gets better audit gets better trusted by the creditors and the shareholders. Yes, audit helps identifying internal controls, which is a crucial thing in any company. The company to do risk management. There is this problem. Members spend quite a lot of money appointing an audit team, costs millions, no question about it. Members may want the auditors to identify, check, right, and catch the fraud, the wrong things, clean up the mess what they see inside a company. Well, auditors don't do that. What the members want out of the auditors is a big deal, but auditors' duty is limited to check on the financial transactions of the company. They can't check all the transactions. You will see, a mid-sized company might easily make 1 million transactions in a single year. Put about 10,000 in a single day, you're looking at a huge number. Can this small team of auditors check all these reports? Completely impossible. What they do is sample checking. Auditors are not there to check fraud. They are just there to check whether the financial reports are decent quality, reasonable quality by looking at those samples. What the members want and what the auditors can do, there's this expectation gap. Take a look at this. There's no human organization without risk. All of us individually, every single organization of ours, there's this risk factors that we inherently face. That means we can't avoid them. Risk is a part, no matter how careful we are. So we call them inherent risk. Imagine, we go from point A to point B in Sri Lanka. We cannot guarantee that everything will go perfect. It won't happen. There is inherent risk. So better controls among ourselves, right? Being careful, being watchful, being focused, being prepared, being healthy, being attentive. Yeah, we can set up a lot of controls for ourselves, right? By being in better control, we can minimize most of those inherent risks. Still, there'll be some risk. That's why the detection is there, to identify, right? Not just the controls, but you have to have a system of detecting whether wrongs are happening, right? Same for a company. We do all these three individually: inherent risk, having a lot of self-controls, and then checks and balances to see whether everything is perfect. Our parents do, we do. Companies also do, definitely, just like us, even more so. Companies face billions of cash is there, thousands of people are involved. Cash flow this way and that way, asset base is huge. There's always risks, inherent. Good internal controls, solid internal controls will help the company to minimize those risks. But then you can't just be satisfied with the controls. You have to set up a detection system. That's why we do external audit. Yes, we have to go for, companies normally go for internal audit also. Let's talk about external audit here, to identify anything is missing even with the controls. Umbrellas here, signify that inherent risk is huge. Better controls could minimize the risk going through the controls, and good detection risk could stop most of it. But can auditors zero the risk? That's not the duty of the auditors. And that's expected. That's the meaning of inherent risk. You can't avoid them. It's there. Control risk, having strong internal controls. Take a look at our own homes, our parents, how much of internal controls they set up themselves. And when you stay alone or live alone, it also takes extra measures to be careful, right? But then we need a system to detect if anything goes wrong. Look at the question. Which of the following is not an objective of an auditor? No fraud? No, that's not a duty of an auditor. A is out. B looks good. Free from financial material misstatement looks good, right? Giving an assurance. Express an opinion on whether the financial statement, that's a better one, right? In accordance with the applicable financial reporting framework, means in Sri Lanka Accounting Standards. In UK, that's their financial regulation, financial reporting council set accounting standards. Report of the financial statements, yes. D looks good. C looks good. D look good. A is not a correct thing. For this one, what is the objective of an external audit? Yes, to protect the interests of the minority shareholders. Not only them, right? A is not correct. To detect fraud, no. Auditors have no duty to detect fraud. They may find, when they go through, they may find these irregularities or even fraud sometimes, but that's not the purpose. Fine, they will definitely inform the directors. Remember, auditors' purpose is not to catch thieves. To assess the effectiveness of the company's performance, yeah, looks good. Provide an assurance on the directors' assertions about the financial statements, which is the better one. A is definitely kind of a little bit good. D, B not relevant. C not much. D would be a better one. No, fourth one would be a better one. To provide an opinion. Who is ultimately responsible for ensuring that the financial statements are prepared in accordance with the relevant legislation? Who's responsible for the financial reports? Directors are responsible for the financial reports. They may not prepare it, they are the people responsible. Which of the following statements regarding internal audit is correct? Now, internal audit is what? There are nothing called internal auditors. They're just employees appointed by the board of directors to audit the things inside the company. Directors can give instruction to these internal auditors and tell them what to do, how to do, and whatever the reports prepared by the internal audit team, that's confidential, top secret. Only the directors get to know about it. External auditors, they don't report to the directors, they report to the members. Internal audit is not a must, as we learned, right? So, incorrect. It should improve the company operations, or that's the correct one. Report are publicly available? Never. That's confidential. Even inside the company, you may not see internal audits being there. The staff are appointed by the audit committee? Yes. Can you remember the corporate governance? You can check the videos on it. They report to management? Yes. Answer is what? Publicly available? No, they are not publicly available. B is the answer. Auditors, yeah. What they do is stewardship, right? Members appoint them. Their duty is to check on the accounts on behalf of the members. Just pay them. So there's agency relationship between the members and auditors. How does the auditing contract begin? Members appoint them by vote of majority vote and the AGM. Then the directors must prepare a contract for them. Yeah, every single term of that contract is prepared by the auditors. Directors only sign it. We call it the engagement letter. There the auditors may say what they want, how long they'll be doing, that they are not liable for the audit report. Say these things. With the content of the audit, how far we are going to do the audit, what are we reading, what sort of accounting standards are we following in Sri Lanka, Sri Lanka accounting standards, and what are our limitations. Right? What the members want, we can't do. Our job is limited. Can you remember the expectations gap? And auditors are not liable if they make a mistake in the audit report. Auditors have a statement telling we are not liable for errors. Yes, while the audit is going on, auditors may decide to inform the board of directors on certain issues. When they find out, as and when they find, auditors are free to communicate to the directors. Maybe fraud when they discover, if that's the case, right? Maybe some irregularities, wrongs. They can freely talk to the board of directors, but at the volition of the auditors. Auditors can decide whether to tell or not. Directors cannot demand information from the auditors, because auditors' only legal duty is to provide an opinion in their report. But in between, that means while the investigation is going on, auditors are free, right, to contact the directors and inform them of their findings, whatever they are finding as and when they find. So this one. Just the employees of the company, auditors have 100% power to question anyone in the company, all the way up to the chairman. Auditors have the power. Proper written representation to talk to the directors, and directors need to be available individually or team-wise or whatever. And yes, finally, the audit report. In the audit report, what do the auditors do? Expressing an opinion on the auditor's report, on the financial statements. They could give one of these three. Number one, unmodified or unqualified opinion. What is it? That means everything is fine. And the auditors say accounts are true and fair. Remember those words. When they say true and fair, that means audit is alright. Next one, modified without modifying opinion. Meaning the auditors still say the accounts are true and fair, but they identify some wrongs in one place, twice, or somewhere, right? So it's the opinion is true and fair, but certain conditions are put with it. Last one, modified with a modified opinion. That means audit is so bad, and the auditors say this is not true and not fair. Fair to come. It's not uncommon to see an audit report with some suggestions. True and fair are given, but some suggestions are given. That means modified without modifying opinion. The general audit report is the unmodified opinion. That means true and fair, and that's it. Which of the following is not a benefit of an audit? Increased credibility of the financial statements, definitely it's a benefit. Deficiencies in controls may be identified during testing. Yes, you might find some. Fraud may be detected. Why not? While you go through that, the auditors may discover some fraud, but although that is not the purpose, right? That is not the intention. Whenever they identify fraud, they may inform the action. Sampling is used. Definitely they do. All four is correct. But what is not a benefit? A, B, C are definitely benefits. Sampling is used is not a benefit. That the members may not like, right? It's not a benefit to the members, because still a chance that some or more wrong information will pass through the auditors without being detected by the auditors. Because what? Sample checking. Internal audit, next thing. Now remember, legally not required. Appointed by the auditors, appointed by the audit committee of the board of directors, not auditors, right? So they are employees actually, appointed by the board of directors. What do they do? Management control. Whatever the board of directors are asking them to check, investigate, and report, these guys will do. They are employees of the company. Some of the audit teams may not even be recognized publicly by the company. They are working confidentially. Employees also may not know, and some, of course, may come out and would be identified as auditors. They're just employees. Their duty is to check every single transaction, not just every single transaction. So many other things, such as this: marketing, operations, sales, supply chain, logistics. There's more. Not only this, right? Research, HR, personnel, so many things are to be checked. Whatever the directors ask, they have to do about it. By the risks, financial property, they do the checking of the financial stuff also, right? They don't just leave it to the external auditors. They may carry out special investigations. They could check whether the company is following the international requirements or the local requirements, like the laws. That's been a review of compliance. What kind of internal audit are we talking about? Financial, operational, project, various projects, value for money. Okay, whatever is done, is the company getting better return on investment? Social and environmental audit, that means about sustainability, environment, community, all that. Management audit, they could even check on secret, right? They could even check on the directors, managers, anybody. Internal audit has some limitations. Number one is familiarity threat. You are employees, so can employees check on the employees? Not a comfortable thought, right? It'd be kind of a bad idea, but it has to be done, right? Internal auditors have some issues with regard to doing their audit uh, independently because of them being employees and being part of the finance function of the company and being too familiar with the employees. Things will be hard, but you need to do the job right. How can the auditors or the internal team can maintain, how can they maintain the independence? One way is outsourcing. If you look at the BPO projects happening in Sri Lanka, a lot of them are internal audits outsourced to foreign countries. Of course, what they check is only the financial stuff, or maybe the some other stuff like the buying and selling parts. Anyway, they'll be independent, right, without pressure. Just could be given independent channels of communication, rather keeping away from any operational duties. That's also something that could give freedom to the auditors. Fraud. That's something inherent in any company, not just public sector. Fraud is very common in the private sector also. Right? Fraud is happening when there are lack of quality in internal control systems. Right? Poor risk assessment. So this may result in fraud. Look at this one. Below are a number of statements regarding internal and external audit, which four of the statements relate to internal audit rather than the external. So we need to find out about internal audit. You might not get a question of this nature, but some drag drop things will be coming, right? So what is connected to internal audit? It's a legal requirement? Definitely not. Internal audit is not a legal requirement. A out. The scope of work is decided by the management. Internal audit? Yeah. B in. Be correct. It can be undertaken by employees of the company? Yes, C. They are employees. C is correct. Ultimately reports to the company shareholders? No, I don't think. Internal auditors don't report to the shareholders. They only report to the directors. D out. Reviews whether financial statements are true and fair? I doubt it. That's external auditor's duty, right? Maybe not. Must be undertaken by independent auditors? No, it doesn't say clearly. Just employees. Dependence of the auditor is not a kind of contractual requirement. Mainly focus on the reviewing the internal controls? Yes. Ultimately report to the management? Yes. So A good? No. B good? G good? D H good? B, yeah. B is fine. C is fine. G is fine. H is fine. Yeah. Can be undertaken by employees. Yes, internal auditors are employees. B. Scope of the work is decided by the management? Yes. Mainly focuses on reviewing internal controls? Yes. And ultimately reports to the management? Yes. This one. The key purpose of internal auditing is to do what? Detect errors and fraud? Yeah, maybe. Internal audit, no? Could be. A is good. Evaluate the organization's risk management processes and systems of control. Looks very good one. B is good. Give confidence as to the truth and fairness of the financial statements. Uh, that's kind of external auditors' duty, no? Not internal auditors. Key purpose is not R, right? So this is only one answer here. Express an internal opinion on the no. They can't give opinions. They have to identify the facts and report to the board of directors. So D out. C out. A and B are good, but I think B is better. B, second one. Evaluate the organization's risk management processes and systems of control. Detect errors and fraud? No. Not only that, right? So B is better. It's a controversial question though. This one. Which two of the following points are correct with regard to internal and marketing audit? Tight question. Right? The scope of the internal auditor's work is determined by the management of the company. Yes. While external auditors determine the scope of their own work. Yeah, can be taken. One should be there in the answer. Internal auditors test the organization's underlying transactions. Yeah. While external auditors test the operations of their organization systems. I don't think that's correct. It's the internal auditors who check the operations. Transactions are checked by the external auditors. So 2 is a bad idea for answer. 3. Internal audit and external audit are usually both legal requirements. No. 2 out, 3 out. දෙක තුන තියෙන උත්තර out. 2 out, 3 out. Internal auditors can be employees of the company they audit, while external auditors must not be. Definitely. You can't have employees as external auditors. So 4 is right. And okay. 4 okay. So maybe B is the answer. That's about it. Please take a look at it and go through it. And I've added up a question set also in the Google Classroom. Catch you in another lesson.